provided in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. It's the final show for the year, and we have great guests tonight. We have Catherine Gross, who's with FIIG Securities, and we have Adam Goldstein from Skeggs Goldstein. They're here to answer any of your questions you might have on the bond or the equity market, so feel free to call us. 1300 30 34 35 and the email yourmoney@Sky News. And my name's Mark Todd, and we've had a great year so far, so let's not get it wrong. We're going to end it on a high. How is December been for you, mate? Is it been a quiet old sort of end of the year, or has it been busy?
You know, I was saying just the other day that, you know, we always say how quick the year goes.
Yeah.
I think this year has gone much quicker than any other year I can remember.
Perhaps because you're getting older.
Well, I don't know.
And it just rapidly goes through and you think, oh, it's another year gone. Come on, stop it. Give me that year back.
Seriously, it just came... It's crept up so quickly. I hate this time of year.
Why?
We've never got enough time to do what we need to do, but we're too short a time to get what needs to be done. So it's difficult for us. This year's particularly hard. We've got a lot of My Super changes happening in the industry. We've got people getting things done for the end of the year, their wash up, getting their affairs in order.
Is that something that, you know, because I often think of June 30th as being the day, but it's not quite that, is it? It's a lot of things in December as well.
Well, when GST was introduced, businesses got their affairs in order and had to report on a quarterly basis. And from that time, I think the whole June 30 rush has been
changed.
Yeah, it's changed. It's moved. It doesn't happen anymore. It's busy all throughout the year now. We have busy time from February to June and July with our accounting lodgements. But other than that, it just doesn't stop anymore.
And Catherine, business, how's it going with you?
Because the same at FIIG. We're really busy. I mean, most of our clients are self-managed super funds. And I think at this time of the year, people start to reflect on, you know, what they want to be doing. They have a bit more time in their life. And they start thinking about investments. You know, for us, you know, we opened twice the amount of accounts in November this year to what we did last year. So business is booming.
And when you think about it, it's interesting that that's happening when you think that where the interest rate settings are. So traditionally, if you listen to the equity guys, they'll be saying, oh my God, you know, equities are the greatest thing in the world, and bonds, it's a disaster, 1994, all that sort of stuff. But it's as if the clients are tone deaf to that, isn't it? You know, the amount of people coming through wanting fixed income.
I think they are. Look, people want income. You know, they want capital security, they want income. And I think the ASX 200 year to date, I think, has returned about 8.5%. And you can buy a bond that generates close to that with more capital surety and stability. So
panic.
The SMSFs, you know, they still want bonds.
And admittedly, 1994 was nearly 10 years ago. And I'd imagine that most of the SMSF trustees now weren't investing in 1994.
And the thing to be conscious of that for all the folks at home, what 1994 was a bond wipeout, and when your equity sales guy tells you, you know, be ready for that, first you've got to work out how old he is. And the second is you've got to try and understand how the world has changed. And the world has changed in a very meaningful way in that we have this thing called forward guidance. So we now know what the intentions are. Whereas in 1994 we had a complete lack of forward guidance, and they just lift interest rates. They would just move them up until they felt they were at the right spot. Unfortunately, they were at the wrong spot, and a lot of people lost a lot of money, and businesses were really struggling because of the cost of borrowing money, and it became a very unattractive experience. And I think they have learnt, and the new phenomena is forward guidance. We all know where interest rates are going to go, or they tell us, and now the question is whether they can get it right or not. So it's a question of whether they, the policymakers, can get it right. But clearly, I've got Nostradamus of the markets here with me, because you've said to me that
really? I was looking at you.
that Adam, you said to me that corporate trustees are the way to go for self-managed super funds. People will be going that way, and I have been watching this at FIIG, and I've been amazed. And I've been talking to our compliance and our ops people. And that's one trend that is very obvious. We see a lot of that. Now, do you want to talk to the viewers that didn't see you on the other week, what the issue is with corporate trustees versus the individual trustees and why you're advocating the corporate trustee?
Yeah, sure. I suppose we should start prefacing the conversation by saying that an SMSF is a trust. Now, because it's a trust, it requires a trustee to be in place to prudently manage and be a responsible entity for
fiduciary responsibility
for the self-managed super fund. There are two types of trustees that can be in place. One is an individual, and the other is a corporate. Now, the reason why these are in place is so that the federal government can legislate superannuation fund. They need powers to do that. So they legislate through the pension powers, through individual trustees, and through Corporations Act, through corporate trustees. So why would you choose one over the other? There are many reasons, but I've got 5 really, really good ones, which I think are the reason why it's a lay down as there why you should have a corporate trustee. So
you're going to give our viewers 5 points. I hope. Okay, that'll be good. Let's go.
Number 1 is succession. And I think I mentioned this last week on this show.
Absolutely.
And succession is all about companies don't die.
Yep.
And I gave you an example about Cat's case, Cat's v. Grosman, whereby one of the individual members or trustees died and had to replace another one in a short period of time.
Yep.
What happened was the children missed out on getting payment from the super fund because the controlling or remaining trustee had control of the funds.
And they decided either to get remarried or they decided they needed the money, and so the kids didn't get their inheritance because of longevity issues. That could be fairly reasonable issues, but at the same time, the person that passed away, their desires weren't met, their goals.
In the absence of a binding nomination of some description on the trustee, if that is absent, and I can tell you that most of the SMSFs I've ever seen don't have this type of instrument in place, whoever controls the trust controls the money.
Yep, right.
So succession is number 1. That's my big one. Second one is adding or removing members. When you have individual trustees, there is a requirement in SMSF that each member must also be a trustee of the fund.
Yep.
So let's say you've got mum and dad, and 10 years down the track you want to add one of the children. It's now mum, dad and children.
Yeah.
You have to change the names on all the investments to mum, dad, children as trustees for.
Right.
So every time you add or remove a member of the super fund, you need to add or remove a trustee at the same time, which requires you to go around and change all the investment names and go through all the process of doing it. Yeah, absolutely.
Yeah. Okay.
Because that's a legal requirement. So that's number 2. Number 3, today the limited recourse borrowing arrangements. Most banks won't lend you money unless you've got a corporate trustee in place. Number 3. Number 4, liability issues. Because it's a company, there's a limited liability.
Yep.
So personal assets may not be at risk, and this is a big one with property these days. Just by
because
chance,
you're taking out a loan to buy the property.
Well, there's more property inside SMSF today, and property by nature has requirements for public liability insurance, for example.
We'll talk about that a little bit later. Yep.
And the 5th one, the final one, is that there is also a requirement in SMSF law to have assets in separate names.
Yep.
So if you've got a corporate trustee, ABC Proprietary Limited here, and mum and dad as the members, it's quite clear who owns the assets.
Yeah.
So you just keep yourself out of trouble. So they're my 5 reasons why you should have a corporate trustee.
And if any of you missed those, just email Adam and he'll give you the 5 reasons to be a corporate trustee. And the reason that you don't do it is because you're trying to save $1,200?
$800 to get one of the
$800. Don't
first
save $800. Spend the money.
$44 a year. Why would you bother?
Exactly. And how much a year?
$44 a year.
$44 a year. If you can't afford the $44, don't have the fund. Our first email is from Peter from Castle Hill. He says, I want to invest in bonds. Should I buy an ETF, a bond fund, or direct bonds? I have $50,000 to invest. What does Peter do?
It depends a little bit on what Peter's trying to achieve. Typically if you invest in an ETF or a direct bond fund, you're going to get a very broad exposure to the fixed income markets, which includes both government, semi-government bonds, and typically those large passive funds are weighted most highly to the biggest issuers of debt. And those aren't necessarily the issuers that you want exposure to.
Because they're low yields.
Because they're low yields, but also they're the most in debt. Nations, typically. So, if you want a very broad market exposure, then, perhaps you look at an ETF or a large managed fund. If you're looking instead for capital stability, transparency, and income, and you want to know what it is and you want to tailor it to your needs, then it's perhaps better to have a look at a direct tailored product. and thus I'd suggest direct fixed income.
We had some people come in today and they were from a certain industry. Let's say, without wanting to talk about those people specifically, let's say they're from the insurance. They're insurance people, they're retiring, and they were very comfortable with the insurance bonds, so the bonds that were linked to insurance companies. And I've noticed that trend, that people who work for a long time and then look to become investors, one of the smartest things to do is to invest in industries that you're familiar with. So if you've worked in, let's say, the airport or whatever it might be, you can buy inflation-linked bonds out of the airport. That seems to make a little bit of sense, as opposed to giving money to other people to look after it, because the only person that loses any sleep is you. Yeah. What would you tell Peter if he was to say, look, I've got $50,000 to invest? Do you have a bias on ETF or bond funds or direct bonds?
I don't have a bias either way. Obviously, it always gets down to what we're trying to achieve.
Yeah.
It can only ever be about that.
Yeah.
$50,000 is a small amount of money.
Yeah.
To get into this type of investment directly, I would imagine. Maybe having the diversification of an ETF would be a preference,
yeah.
or a good fixed income manager.
Yeah.
But I'd like to harp on your point about transparency, and that is one of the downsides with ETFs and managed funds is you don't actually get to see what's happening inside.
Yeah.
And a lot of clients like the transparency of my income's coming here to my bank account because of what the capital value is doing with the bond.
Yeah.
So it depends on where you're at, what your level of understanding is as well.
That level of sophistication.
Particularly, understand what a capital structure of a company is to start with would be a good place to start.
Yeah. Look, we will we'll talk more about the capital structure, but we have to leave it there for a very quick break. We'll be right back after a message from our sponsors. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is Catherine Gross. She's also from FIIG, and Adam Goldstein from Skeggs Goldstein. They're here to answer any of your questions, so feel free to pick up the phone. Call us 1300 30 34 35, and the email is yourmoney@skynews.com.au, and we have our first caller for the night. It's from Richard. Richard's from Sydney, and he wants to talk about Silver Chef, I think. Hello, Richard. How are you?
Oh, hello, Mark. Look, I really hate to crash the party, mate, but today a terrible downgrade. I mean, I remember seeing Roger and you on Silver Chef, you know what I mean? And I did some in-depth analysis on the stock, and I mean, it seemed to be it was going to be a slow train wreck, mate, you know what I mean? I borrowed enough stock, I've shorted it, you know what I mean? Today's the payday.
Yeah.
The stock's down big time today. The only thing I'm worried about is, how's it going to affect the bond, mate? You know what I mean? Which I think you guys actually did the float on.
Yeah, so we did it's a $30 million float. I think it's trading today at about 670, so it's down a small amount. 2018 maturity. It's a senior debt. They had I think it was a 13 mil down to 12 million, 11.8 million, because one of their businesses isn't growing as quickly. We're comfortable with the asset. We like the company. We like the business that they've got. It's certainly not as volatile as the equity. So if you're shorting an equity, that's probably a good thing to do. I don't necessarily want to short equity on some of these smaller organisations, but trade the equity as best you can.
Mark.
Pleasure. Thanks, Richard. Now, where were we? I wanted to ask you about the concerns around SMSFs. I mean, what I saw about the head of Morgan Stanley talking about he's worried about the property market will crash, and therefore all these SMSFs will be hurt. Do you have any take on that? What's your thoughts on that?
When someone says the concerns around SMSF, I say, which concerns are you talking about?
Yeah.
Firstly, I hadn't heard that, so I'm not quite sure. But
he just felt that they'd borrowed. He felt it's such a huge potential train wreck because they're borrowing money to buy property. But when you look at the data, it's not actually that much as a percentage of the total property pool.
So it's less than 3% of the residential property market is in SMSF borrowing arrangements or residential property per se.
Yeah.
So it's not a big exposure by a long shot. What I think some of the gatekeepers in this area are doing is the banks are being quite conservative. From my experiences, their LVRs are quite reasonable. They won't let you borrow over 80%. They won't do the lending until there's sign-off from a financial plan about cash flow, risk, liquidity, and being able to pay the debt back. So there are safeguards in place for these things. I also heard the other day that one of the reinsurers was speaking about putting in place different arrangements for the banks to put some...
That's Genworth, yeah.
Genworth was exactly right. So I think the market will drive this in the right direction. I don't think SMSF trustees have a free rein to go and do what they like. And it's that, people look after their money different ways than someone else will do it for them. You can hardly say that all the professionals are doing the right thing anyway. So
yeah, that's right.
It's not as if...
I mean, Catherine, you worked in banking, and I would think that the first person to look after themselves are the banks. So, not that we want to be negative on the banks, because we love them dearly, but if they're lending the money to these organisations like SMSF, you think that they probably have some benchmarks around how to make sure they don't lose their money?
Of course they would. I mean, I think, the banks are regulated and, based on the rhetoric we read in the newspapers, may be increasingly regulated, especially in the housing market. I personally think that we need to give SMSF investors a little more credit.
Yep.
I think that the majority of trustees are going in with their eyes wide open, and if they're not sure, they have an advisor who's providing advice, and that advisor doesn't have any vested interests. I think when you have another bank coming out expressing concerns about a product, you have to think about vested interests and whether they've got an alternative.
For the multi-billion-dollar self-managed super fund, fastest-growing segment, you'd think the banks would like to get a part of that, whether it be in the form of making sure you don't make a mistake, or whether it be in the form of just give us the money because we'll look after it.
That's right. I mean, this is a...
Not that we're saying that Morgan Stanley are doing that, but there's a natural bias. They want to grow their business.
It's a $500 billion market. It's a third of all super. I think their banks, profit is their motive.
Yeah.
And... thankfully they are innovating and they are coming up with some quite interesting products that might be suitable for some SMSFs, but not for all. So I think there's a place for all product.
Yeah, I just don't see it. Like, there's too much hype around this risk at the moment, and I think it's early days for people to be talking like that, to be honest.
And you're in a strong position to be able to talk about this because of your chairs the New South Wales SPA. So for the viewers that aren't aware of it, do you want to just briefly talk about what SPA is as well? Because I think that's really important to understand what education is being dealt with at the moment, what that industry itself is looking to try and achieve.
Well, the last thing the SMSF industry wants is to have over-regulation. It's the last thing they want. So SPA is one of those associations that was established 10 years ago, and its sole focus is to increase professionalism and education in the advisor space to the SMSF marketplace. They do that through a number of programs and courses that they run. They've got a specialist advisor designation and a specialist auditor designation. Fantastic organisation. Their training and their education standards are quite high.
And give me an example of what they're training people in. Like, who's an advisor? Is it a planner, or is it an accountant, or give me an example of the people that would be involved in members of SPA.
Well, SPA has just under 3,000 members at present.
Yep.
And they did a survey a year and a half ago, and they determined that of those 3,000 members, it represented over 80% of SMSFs in the marketplace.
Right.
So great penetration into the industry. Education programs, the SSA and AUD are set at a master's level, so they're actually quite complicated. There's nothing easy about them. We run regular monthly events for members on presentations on CPD, education, annual conferences, half-yearly technical state conferences. It's quite detailed. The best thing about it is that the membership base is made up of a conglomerate of different professions, mostly accountants and financial planners, but there are also a high representation of lawyers, actuaries, auditors, broking industry, property industry. So it's a great mixing pot of different advisors who get together on a regular basis and talk SMSF.
Do you talk to the government? Are you a lobby group to the government?
SPA as a national organisation has significant involvement with discussions with the regulators, particularly ASIC, ATO, Treasury, on what they putting forward their views on what the industry should look like. And one of the best things about Spar is actually provide some solutions to some of the issues that are hanging around. So they have had great success.
You've been to the odd Spar conference. What's your take on it?
Look, I think it's a fantastic mix of perspectives. You'll typically have a mix of advisors speaking, of product providers speaking, of research houses, and I find it to be a fantastic learning environment. It's great networking as well for people within the industry and looking to be part of the industry. But you just come away with ideas. It's an idea pot.
Just for the viewers at home, what's a product provider? Give me an example.
Look, a product provider could be anyone from someone like Vanguard, who obviously has a large position in the passive fund
the ETF
market, through to investment banks, through to platform providers, administration services. It's all the people that service the industry.
We have to go to another very short break. Feel free to call us on 1300 30 34 35 for any questions you have on shorting the market. And the email is yourmoney@skynews.com.au. We'll be right back. Welcome back to the final Your Money, Your Call for the year, bonds versus equities. I'm Mark Todd, FIIG Securities, and we have Catherine Gross, who's also from FIIG, and we have Adam Goldstein from FIIG Goldstein. They're here to answer any of your questions. Feel free to call us 1300 30 34 35, and the email, as you know, yourmoney@skynews.com.au. And we have John calling, and John is from Perth. Hello, John. How are you?
Oh, hi, guys. Good, thanks. Got a good show there. We should change the name of our stock market, I think, to taper market.
The taper market?
I didn't know what the word meant till about 3 years ago, and it's the only thing I've ever heard since.
That's right.
With this mountain of debt and money printing, or counterfeiting, I suppose you can call it, and it's tossed in these ridiculously low interest rates, as long as it lifts everybody's stock and house prices, everybody cheers and says what a wonderful thing this is.
Yep.
Isn't it about time we stop taking these wishful thinking pills? It's just a Ponzi scheme.
When you were a child, did you ever play musical chairs? Mum would put it on and turn the music off, you jump on a chair? Well, that's what this is. This is musical chairs with money. They're waiting for the music to stop, and when the music stops, everyone will be running for their chair, and they hope that their chair will pay them cash, and that's essentially what they're happening. We are seeing at the moment the market, in the equity market, correct, because people are seeing the rally that they've had, and it's real money to them, and so they're banking that money. And I think that the taper experience will be challenging in 2014. What do you think?
Yeah, I agree. I mean, I think, part of the reason we're also seeing a sell-off in the Australian equity market is people are starting to have real concerns about the Australian currency. We've also had the governor of the Reserve Bank talking down the currency.
Yeah.
And,
bang. He wants it in the 80s.
I think that the concerns about tapering are impacting the Australian dollar, and people are also selling Aussie equities. Offshore people are selling Aussie equities for that reason. They're concerned about
they
the
clearly
impact.
they think that's why we've seen that all that in the blue chips being sold off, because the fund managers are saying, hang on. The man that runs the place, theoretically, outside of the government, but the Reserve Bank governor is saying, I think the Aussie should go down to 80. And for the viewers at home, that's a meaningful loss to some people who had it at 93, 94, 95, 96. If it drops down into the mid-80s, you've actually, regardless of what the share price has done, the currency's really hurt you.
Lose 8 to 10%. If they're not hedging their currency exposure, which many don't, especially the large passive investors, then they just sell out of the Australian equity to protect against the fall in the currency.
Which is what we saw in June of this year, when they had the taper talk originally, and everyone panicked and got out. And I guess it'd be hard to imagine there won't be some sense of panic, nervousness, whatever, volatility, whatever you want to call it, once they finally start to taper. Are your clients concerned about that?
Not really.
That's good. That's what they should be. I mean, they shouldn't be trying to trade the market.
Not really, because, at any particular point in time, there's always something that's of concern around the world. It doesn't matter if it's tapered this day or something else the next day.
I'm going on holidays at the end of the year. I'm concerned about the currency, I tell you. We are going to go to another very short break. Please feel free to call us again, 1300 30 34 35, or the email, as you know, yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. Joining me tonight is Catherine Gross from FIIG as well, and Adam Goldstein, who is from FIIG Goldstein. They're here to answer any of your questions on any of your themes. Our number is 1300 30 34 35. The email yourmoney@skynews.com.au. And we have another caller, and the caller is Wayne from Brisbane. Hello, Wayne. How are you?
Good, Mark. Thanks for taking the call.
Pleasure, mate.
My questions are related to a couple of points that were made earlier in the program.
Yep.
I currently have a SMSF in personal trustee names.
Yep.
Considering investing $400,000 in a bond portfolio,
Yep.
if I invest in the bond portfolio tomorrow, for example, then in a month's time or next year sometime decide to convert this SMF into a corporate trustee structure,
Yep.
how simple or costly will it be to change the names on the bond portfolio?
It is not costly at all. Well, hang on, let me rephrase that. Depends who you go through. Clearly, I've just had the experience, that's why I was talking to Adam about it today, this week, where a client of mine had changed and he had 40 bonds, I think it was, and so we had to send out 80 confirmations, we had to change it all, and we had to do it all. But that came at no cost to him. That was just part of the service that they offer. Now, will that be an ongoing free service? I don't know. It was very it was an onerous experience. So I think we're trying to look at how to make it more productive while still be compliant. So we might not send all those confirmations and ask, do you want to do that? But in essence, the short answer is it's not that expensive to do that. It's just a question of how big your portfolio is, and if there is some costs later on, I don't see it as being a major cost. But in this time frame, in this next 2 months, if you're with us, it won't cost any money. Maybe with other organisations, but I think you should just ask that. I think they should be able to offer that right now.
It's a very time-consuming process for whoever's doing it.
Yeah.
Whether they charge you to do that service or not is entirely up to that advisor or whomever you use.
It really comes down. So what happens with us is that we open up a brand new account. It's an entirely different account.
It has to be.
And so we then have to transfer the bonds. We sell from one at a non-capital benefit. We sell to one and we buy from the other. Yep. You know, that's how we do it. We're lucky that we've got reasonably good systems so that we provide the pricing to the team that does it, and so they actually look at it all and it's just a keystroke. And maybe there's some margin for error. We don't know of any errors that have taken place because keystrokes being what they are. But they would sort of stand out that if you made a mistake because you've still got a bond in one account and not the other. But I think...
So it would be a cost recovery exercise if there was ever a cost imposed rather than
that's right. So
rather than exchange costs or a...
Yeah, that's right. So if you can imagine you had 100 bonds in your portfolio and as a whim you said, look, let's shift it, that somebody will spend a greater part of a day trying to work out the prices, move them all over. The pricing's easy to get to, but you would see some complaints. So you see some pushback.
So with your bonds, can you just you can't actually change the name or the ownership on the existing bond? You're starting a brand new one up. Is that how you have to do it?
So what we do is we open up a brand new account and we sell from account A to account 1A, and that's what we do. And that way we keep them at the same price. So there's no.
But what if there is in that sale process? There's actually a taxable transaction that takes place.
So we call it a non-capital event. So we document why we're doing it, and so that becomes part of your transaction statements, and so your accountant can make a decision if you've had a capital event. But generally these changes come from the accountant. So we make a presumption the accountant knows what they're doing. You have met plenty who don't, so maybe that's but we can't really test that.
There's no change in beneficial ownership of the actual underlying asset.
Yeah.
So as far as the tax is concerned, there shouldn't be any taxation consequences, nor stamp duty, nor anything like that. So it's really just a time process and getting the actual transaction done, including a new bank account. Changing where the dividends and distributions are paid, where the fees are deducted from, pension payments come from. It's a process, it's time consuming, but just find a really good advisor.
They always change the bank account?
You have to.
Right. Gee.
Because
pay the $44. I mean, please, folks. I mean, it's just...
I can't stress this enough that individual trustees is just lazy.
But it might just be it's also for Wayne who's rung through. It might just be that the evolution of the market the person hasn't realised. So certainly Wayne, from these sort of shows, they get it and they go back to their guy. Why didn't you do that? Oh well, I just didn't think that through. I suppose because to your point, if everyone knew what they were doing, SPA wouldn't exist. So you'll be pushing that heavily, I would have thought, in defence of lazy accountants.
I didn't say that word either.
Clearly you didn't. Clearly you just said they were. I don't know what you're
just lazy to not
something.
Do the
not
extra,
that bright.
to do the extra work.
I wanted to ask you about the role. We're talking about the evolution of corporate trustees and about how people are changing their circumstances. What about your perspective as a woman versus the husband? That that sort of, I know that's a theme that you're keen on to talk about, how that's a different investment strategy, if you know what I mean. Like, how does that role play?
I'm not sure it's a completely different investment strategy, Mark. But what I would say is I think it's recognised that women are generally more conservative than men.
Yep.
So they take more conservative decisions. And
what was your Lehman Brothers thing?
Christine Lagarde famously said last year when interviewed by a journalist, if Lehman Brothers had been Lehman Sisters, we might be in a completely different environment now.
Well, that's right. That'll be right.
So, I think it's recognised women are far more risk adverse than men, and that has positive and negative consequences. When you're in a time of volatility and market downturn, you might then see that women's portfolios outperform men's. But, in a time where you're in a high growth environment, women are potentially making decisions that impact them negatively by not investing in higher returning stocks. But the other thing I'd add to that is that women are living longer than men. The average life expectancy of a woman is 5 years longer than a man, which means that when planning for their retirement, they need to be thinking about that, that they may outlive their husband, need income for longer, and you'd need to talk more about that, Adam. But on top of that, women often have a period of their lives, typically in their prime earning years, when they're not working. And they need to be planning for that and thinking about what they need to do, either to continue to contribute to super or have their partner contribute to super, or to think about how they invest such that they're on track for their retirement from quite a young age. It's too late to start thinking about it at 55.
You've got to go early. Now, speaking of longevity and the like, you put out the Skeggs Goldstein, it's the SMSF newsletter, and I feel that part of the things you're talking about, this report on the ageing population here, which is an interesting thing because it's clearly what is troublesome to a lot of people. It's the classic, you haven't got enough money, and they come to you and say, look, I've got $1 million, I've got $500,000, I want to retire. How do you manage that? That's a tough conversation, isn't it?
Well, it is, and I think one of the issues the industry faces is that when super contributions are set at 9%, for example, going to 12%, that gives people the feeling that's all they need to do. When in fact that's not even the minimum that's required. So what I feel that we could be failing ourselves a little bit here because we tend to rely back on what is legislated and think that's going to be enough to be contributing to super, but it's nowhere near it.
And that's a simple presumption. I mean, I can understand why people think that. Absolutely can think that.
And then when you combine things like reduction in contribution caps, for example, make the process even more difficult because what actually happens is not very many 25 and 35 and 45-year-olds have $25,000 a year to pump into their super. They've got kids and mortgages and private school fees and everything else. So what used to happen is you played catch-up football. So once you turned 50, you had a higher contribution cap, and it gave you time when you had free cash flow to make those catch-up contributions to get where you needed to be. But it all comes back at the end of the day to having the discussion with someone about what is it that I actually need to be providing for, what is the number, what does it look like, and work backwards from there. It's just one of those things that just fails to get done. And
do people, you think, accurately represent what number they need? They know their budget, they know how much money they need, or do you think it's just...
No, they don't. No, they don't. We spend a significant proportion of our time just trying to understand where people's cash flow is at. Because I've got clients who live on 30 grand a year quite happily.
I'll send my wife to you because I don't know where the cash flow goes.
And others that can't live on 300.
We'll have to leave it there. We'll go for a very quick break. We'll be right back after a word from our sponsors. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. Joining me tonight is Catherine Gross, who's also from FIIG Securities, and I have Adam Goldstein from Skeggs Goldstein. They're here to answer any of your questions. Feel free, pick up the phone, 1300 30 34 35, and email yourmoney@skynews.com.au. Now, Catherine, I wanted to talk to you about what you do at FIIG, which is the Managed Discretionary Account, the MDA. What is it? Can you talk to the viewers at home and give them a sense of what it actually means to be in an MDA?
Yeah, of course. Look, an MDA is really, for the viewer, is like a managed fund. But instead of owning units in a trust, you own the physical assets in the account.
Yep.
And the reason that's attractive is it means that you can have absolute transparency about what you own.
Yep.
And you can see what the underlying price is on each of those assets, so that you feel like you've got your arms around what you're investing in.
Yep.
And typically on a managed discretionary account, the discretion is provided under a mandate to the investment manager to make decisions about which assets are in the account, so that they can manage the account to give you the best return or capital stability or whatever the strategy is on the account.
How do you define the strategy? How do you come to a conclusion what the strategy should look like?
Well, for FIIG, we're a fixed income broker.
Yep.
So we're experts in fixed income. And what we've done is really listen to the SMSFs that we speak to. And what they tell us is that they come to FIIG because they want capital stability and they want income.
Yep.
So when building a mandate, that's foremost in the mandate. You know, we're not looking to generate a 15 to 20% return a year.
Yep.
And what we're trying to do is generate a return over cash for those investors.
Yep.
To meet their requirements for capital stability and income.
So what would the return, generally speaking, the average, are they trying to target 6 or are they trying to target 5? Or what
look,
do you
I think, it's around 6%, and, we're in an environment where, we've been seeing interest rate cuts. So, we'll call it somewhere between 5% and 6.5%.
Yeah.
Yeah.
How does that sound to you? What, I mean, are you saying...
Yeah, what were the... so how many securities do you think would be in the MDA? Like, do the clients get to choose themselves, or is it purely up to the fund manager?
What we would typically do, and it really depends on the sort of MDA that you're looking to run. If you're running a wholesale discretionary account, the assets that you'd have in it might be quite different to one that retail investors were investing in. If we're looking at something for a wholesale investor, what we might typically look to do is something that was sort of 5 to 10 securities with discretion to manage that, within the strategy's core boundaries. Yeah.
And give me an example of what you put in it. Have you got is it Sydney Airport, or is it, what would you...
Well, we're in the early stages at FIIG on the managed account front, so we would probably start really simple.
Yeah.
Sydney Airport's a CPI-linked bond,
Yeah.
and we probably wouldn't put that in our initial capital capital stable income fund,
Yeah.
Just because it's not a floating or fixed rate. Well, it is a floating rate asset, but it's linked to inflation
right.
rather than interest rates. So we'd stay pretty simple. We might put some National Australia Bank bonds in there.
Yeah.
We might put, an infrastructure asset of some sort.
Dampier Bunbury natural gas pipeline.
That's exactly right.
These
Or the
acronyms,
South Bank TAFE.
I get very confused. DBCT, DBNGP. Oh my gosh! Just give me a simple name, please.
That's exactly right.
How does that sound to you? That sort of stuff. Is that how important is liquidity to you for the clients? Because clearly there is a level of liquidity in a managed discretionary account, but at the same time you're saying to somebody, here's where I'm going to manage the cash component, and I'm getting better than term deposit, so therefore think that way. I mean, how does that...
Well, liquidity is one of the 5 requirements to address in structuring an SMSF investment strategy.
Yeah, right.
So it has to be part of what you talk about.
Yep.
You have no choice anyway. But from an investment perspective, it depends upon which stage of the super journey the client is on. If they're in an accumulation phase, liquidity is probably not that big a deal. Mm-hmm. But if you're in drawdown phase, it's everything. That's number one. That's
the secrecy risk that we talked about before, where you can get hit with a really bad experience when chap's selling Silver Chef, and that's your time to sell, and all of a sudden he's making really good money on his shorts, but you're suffering because you're part of the market movement. You're looking to retire, so you sell it on that day, and
you can only worry about the things that you can actually control. You cannot control market risk. All you can try and do is reduce the exposure to or manage it as best you can. But what you can control is liquidity and cash flow.
Yeah.
So if you get that part right first, you're going to significantly reduce the risk of your clients losing money.
But we know that there's a lack of liquidity when everything gets hairy. I mean, that's just the reality of life. If you want to be in liquid assets, being government bonds, I mean, or, I don't know, Telstra. But if you want growth, where's the trade-off look like to you? Because we know that when there's a GFC, there was very little liquidity anywhere.
Yeah, a listing doesn't give liquidity.
No, gosh no. I've still got some of the, I've still got some of the equities that I had, you know, the GFC that I'm still waiting for my stockbroker to try and get the price up.
But even professional managers don't get this right.
Yeah.
We have clients who receive letters from their default super fund saying that their fund has now been frozen because it's 2/3 invested in unlisted direct property. Now, we're talking about the retirement benefits of employees here. How does that happen? So liquidity is all that really matters when you're in drawdown phase. There is no doubt about it. Or we should be careful not confusing liquidity and cash flow as well in the same sentence, because that may be what the discussion.
Because you don't necessarily have the liquidity if you've got all the cash flow that you want. So that's interesting, isn't it?
Well, you've got cash flow, you don't need the liquidity. If you haven't got cash flow, you do need the liquidity. So it's a matter of balancing these two. They're not competing; they're sort of working together. But balancing them so the portfolio works for what the client's trying to achieve. At the end of the day, is specific to what they're trying to achieve.
Tell me about how you find a good advisor. How that works.
Well, you can always.
What do you look for? What's the filter?
You can always ring 1300 SCEGS.
Thank you. That was the very subtle plug. But what do you look for?
It's a very difficult question because it depends what type of advice you're actually looking for. And that's always around complexity. CEG did a research in the States and they found that high net worth clients, that is clients with investable assets of $1 to $10 million, had on average 3 advisors.
Oh, really?
Absolutely. Now,
Equities.
well,
is it around, as Catherine said, is it around asset classes or is it around?
No, it's around legal, accounting, investment, estate planning.
Yeah.
Then you've got equities, and you got. So by the time you put this all together, it would be very difficult, actually almost impossible, to find an advisor that is across everything. It just can't happen. So I often describe what we do at our business as being more like the conductor of an orchestra. So I don't need to know how to play the oboe, but I need to know when it's got to be played. So my role is to have, to be the person who has the highest understanding of what the client's trying to achieve. Everything that needs to be known about them, I will know. And then I bring to the table the people with the expertise in particular areas. That's why we use you guys.
Thank you. We will go and take another very short break. We'll be right back for our last segment of the night.
Like YMCA.
Welcome back to Your Money, Your Call. I'm Mark Todd, FIIG Securities, for the final show of the year. Joining me tonight is Catherine Gross, who's also from FIIG, an MDA specialist, and Adam Goldstein from SCEGS Goldstein. And he's here to answer any of your questions on the final section. And we have one. We have a caller, and the caller is Michael, and Michael's from Sydney. Hello, Michael. How can we help you?
Hi, thanks for taking my call.
Pleasure, mate.
I'm retired and I have a range of investments, mainly through a vehicle called Investment Exchange. But there are 2 that I just wanted to ask the panel about, which I'm concerned about. This is in fixed interest. One's called Vanguard Australian Fixed Interest. And the other one's Macquarie Income Opportunities. And they're both giving me a negative return at the moment. I'm just wondering why. And
wow. They shouldn't be doing that. That's the wrong one. Okay, so Vanguard and Macquarie. What was the Macquarie called?
Macquarie Income Opportunities.
Income Opportunities. I love the way they come up with all these different names to try and take your money. It's just fantastic. Macquarie Pink things. Look, we don't know enough about it to be able to give you an appropriate answer. But one thing that seems clear, that you probably shouldn't be losing too much money in a fixed income fund. That's that's your benchmark. That I sat today with Aberdeen, which is a fund manager, and he talked about how you manage that shorter duration, and what he was looking to achieve. And it wouldn't occur to me that too many fixed income funds would have lost that much money in this environment, if at all. It just doesn't really make much sense.
I must admit, look, Vanguard, in their defence, generally are a relatively low fee option. So I have to sort of ask myself, is there more fees being overlaid on top of the fund investment that you're making.
And they're high-quality companies. So Vanguard's a quality company, Macquarie's a quality company. There shouldn't be something... I mean, it doesn't really make enough sense, so you'd want to drill down a little bit more. Certainly email those guys and say, can you give me, A, your investment advice, B, what's your strategy, C, can you defend why you're losing money? We've got cash at 2.5, you're buying assets at 6. It's, you know, very hard to understand why you're losing too much money unless you're playing around in the derivative market and maybe you've lost some futures money.
Or unless they're a long duration product, but they don't sound like a long duration.
I'd imagine the Vanguard fund would have a mixture of fixed income securities, including some 10-year bonds, which
doesn't make any sense. Look, that's our final show for the year. Thank you all for taking the time to email and phone in. We've had a great old time. I think we'll be starting back in late January, maybe early February. Depends on what Sky's very nice to me. I'd like to thank our guests, Catherine Gross from FIIG and Adam Goldstein from SCEGS Goldstein, and to you, all the viewers. It's been a great year to date. I'm Mark Todd from FIIG Securities. Have a great night. Go the cricket.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.